Thank you so much for joining me here at Commercial Property Club, our podcast. We're on podcast number 44. So excited to be with you today. I've been focusing practically the last one or two episodes on the North Texas axis, particularly the city of Frisco. There's a lot of things happening in that axis. We're talking about cities like Plano, cities like McKinney, cities like Aubrey, cities like Prosper, Melissa. Ton of things happening for those who are particular about driving cities for investment purposes when it comes to the acquisition of an apartment, specifically, and also what makes all these kinds of investment a very good investment, what drives them, what makes them profitable. That's what we're going to be talking about. Last two episodes we focused on the city of Frisco. I would be doing a lot of episodes based on that axis of Texas so that we can understand what it means to invest in this particular place actually. So today is another episode in which we'll be looking at the city of Frisco, what is making it a particular spot where investors can put their money also too. All right, I'll be right back. Hi, thank you so much for joining me once again. I'm back here at Commercial Property Club, our podcast. Just like I said, today's topic will be tagged the universal effect. How entertainment tourism is really defining the South Frisco multifamily investment. You can't but to talk about that. That's the particular topic we'll be focusing on today. And we're going to see some aspect of multifamily, the factors that drive investment in the multifamily aspect of things. The city of South Frisco, actually the southern part of it, and largely the cities around it, they're enjoying the privilege of what I call the universal effect, in which what's driving lease, what's driving population growth, what's driving job growth, and that's what we're going to be looking at today. I'm your host, Ola Ibiwoye, here at Commercial Property Club, always bringing you valuable information when it comes to the multifamily sector of things. So the new anchor of North Texas, as we already talked about, we talked about it the last episode. We were largely talking about the suburbs of Dallas, which was Frisco in particular. We're talking about the aspect of which is making Frisco a great city to invest right now. We would look at Frisco through a number of years back, largely in the spectrum of corporate commuting lenses. Missing the big picture will be for you to still think that's the case right now. But actually there's been a shift. Yes, there's been a shift in Frisco, which was formerly defined by corporate headquarters, the likes of your PGA, the luxury sport complexes of FC Dallas, but right now as we speak, the city is bracing for really a massive permanent structural waves. It's what I call the universal effect. Unless you've not been listening to the news lately, or rather paying attention to what is coming or happening in North Texas axis, you probably have not heard about it, or maybe it's been elusive on your side. The universal destination right now is the city of Frisco, the South City of Frisco. And that's what I mean by that is that they're launching, they've already actually launched it, a 32-acre universal kid resort, where you find the kids, you find the parents also too. Practically the universal resort investors, they have a campus now in the North Frisco axis. It's a 32-acre Universal Kid Resort, which opened in July the 1st actually. Tickets were on sales, and the move towards that opening was quite great. The 300 room luxury hotel is fully built out. The workforce on board is in its hyperdrive actually. Today we are talking about the theme park tickets or tourism in terms of the demographics. We are going to be talking about the capital mechanics of real estate. Entertainment tourism actually is completely something that can alter a sub-market demography, and the city of Frisco is experiencing that right now, driving an entirely totally different spectrum of tenant profile, which creates a massive macro economy pocket of rent that are resilient in the South Frisco axis. If you want to know how the single mega project is fundamentally redefining underwriting for investors of multifamily asset in the North Texas, then you want to take down notes for this episode. So we're going to talk about some aspects of blueprint that we need to focus on when it comes to investing in the north axis of Texas, Frisco in particular, the south axis of Frisco, because of the universal effect. Now, I made mention of the fact that corporate giants in the past have been the talk of the town when it comes to that axis. When you only need to drive through the downtown of Frisco, you see the likes of corporate giants in Toyota, JP Morgan, and what the likes of them, IKEA, what have you. Beyond the corporate cubicles also too, we want to see the macroeconomy of tourism. How does that affect the multifamily nature things? Historically, when general partners or GPs underwrites a deal in Frisco, the narrative has always been looking at high earners, the white-collar high earners, professional commuting to corporate headquarters. Like I said, that's what you look at. You look at the earning potential of all this corporate spectrum, the likes I talked about, the likes of the Toyota, the likes of JP Morgan, even FedEx, as well as Chase also too. That tenant base is phenomenal. Don't get me wrong. They're quite a chunk of renters that you really want them on your books. But it's fundamentally tied to office corporate employment metrics when you want to look at it critically. Now, the Universal Kid Resort, like I made mention, completely diversifies the risk profile of South Frisco multifamily. We are moving from a standard office of economy to a massive multi-layered entertainment tourism macro economy. That's what we're seeing unfolding right in front of our eyes. Think about it, the numbers. This resort is just drawing transient families for a weekend stay. It's a structural employer. The Universal Studio is injecting thousands of specialized, stable, permanent jobs into the immediate sub-market. So you're not only looking at the transient visits of clientele base, which is mostly family coming through, you're also looking at the job factor of things, the people that are employed in this resort. So largely you want to look at the things that spans from property operations. I'm talking about job employment and engineering and hospitality management to corporate marketing, as well as a lot of entertainment logistics. And a lot of these individuals are looking to purchase properties in the likes of the 700s. That's how much it takes to get into that axis right now when it comes to single family suburb homes in Collin County, especially with the 2026 mortgage rate holding firm. The rates are still holding firm as the time of the recording of this podcast. They are the ideal profile for stable Class A and Class B workforce housing. What I'm trying to say is that, entering the level for that axis is in the 700s. If you could get in the 500, that's $500,000. That's pretty good. So a lot of them will be shooting towards renting your Class A, your Class B asset base. Now, this mega project of the University Kids Studio creates an insulated pocket of local economic demand that operates independently of the broader tech or banking employment circle of things. When you introduce thousands of permanent localized jobs for a single submarket, you create an absolute baseline of housing absorption actually that simply didn't exist if you look at it in the cycle of like 1 or 2 years ago. Another thing I want us to look at today is underwriting the universal shift. What are the key performance metrics that we're going to look at? Now, let's look at the financial underwriting mechanics. How does a massive team packed destination actually move the needle on a multifamily pro forma in the south axis of Frisco? There are 3 core metrics that are shifting right now in weighing the second quarter right now, 2026, I believe. No, we're actually in the 6th month right now, the 7th month actually, I'm sorry. So how? Let's look at the short-term rent premium, and also sometimes what can be, which is the flex leasing. Savvy operators are no longer underwriting 100% long-term traditional leases actually, because of the influx of visiting families, vendors, and corporate trainer coming into the Universal Parkway. Progressive asset managers would are pivoting, dedicating there about 5% to 10% of their unit mix to institutional corporate housing or specialized flex leasing programs, which can accommodate this. This captures a slice of the tourism actually, and the vendor traffic, which I mentioned earlier on also too. Properties are driving a premium on a per night actually basis, sometimes per month basis, effectively boosting your gross potential rent. That's what some asset managers are doing without needing the market-wide inflation, if you look at things critically. Another thing we must look at also too is the retail concessions and the neighborhood cohesions. The 32-acre footprint of the resort has completely accelerated actually, and surrounding commercial mix-up use also to infrastructures to new dining, retails, and experimental lifestyle centers are sprouting directly across from parkways, and these are increasing the neighborhood traffic. You have to really look at that also, to that also boost your overall net operating income. For multifamily asset within 3-mile radius, this means your workability scores in terms of tenants having access to facilities like that, things that they could usually help to boost their lifestyle amenity, just experiencing a 5-year jump in about 12-month period. In other words, there's been a lot of construction, there's been a lot of injecting of mixed-use retail outlets. Then high-end retail density translates directly to or sticky tenancy and a high willingness to pay premium asking rents. Think about that. Another thing I want us to consider is the concession bond of acceleration. As we discussed in the previous episode, the broader North Texas supply wave led to some heavy concession packages over the last 24 months. But in South Frisco, the massive staff onboarding for this July grand opening has created an artificial supply constraint. Apartments are getting filled up faster than local teams could anticipate. Actually, we are seeing properties within the direct line of sites of the resort born of their 4 to 6 weeks free specials ahead of the scheduled, allowing operators to, and this allows operators to capture through effective rent growth, because in anticipation of this grand opening, actually there's been a lot of influx, and the concessions are fast burn out, and operators are really capitalizing on their growth, which I think is a smart thing. It's a perfect time to do that. Now let's talk about another aspect of the strategic playbook for us limited partners, for us general partners. What are we going to do strategically with this section of the market, section of prospective market that we might need to invest in? If you are a limited partner looking to place capital in the Dallas area right now, you need to know how to really separate the groups that are riding the wave from the groups that are truly executing deals. You have to identify who is playing in this particular sector of things. That helps you decide who you can partner with on limited basis, who's what kind of offerings they're given in that aspect. When a sponsor brings you a deal in the Frisco, maybe Plano Axis also today. Of course, Plano Axis. Here's the universal playbook you need to use to evaluate them. Actually, once you get into that aspect of vetting deals, look at the universal aspect of things that we've talked about, the information we've talked about right now, and use it to vet the deals. Audit the pro forma employee capture rate. You want to look at that. Ask the GP, how are you structurally targeting the incoming universal ecosystem, looking for teams that are, employed in that particular aspect of things. Look at the Vantage play. Class A property eating stability right now are fantastic, but don't overlook well located late 90s also to some of your 2000 vintage class B assets also. So they matter. You want to look at what kind of asset these are. These are the sweet spots for value add tech upgrades, adding smart locks also to your upgraded futures also to, and modern co-working space directly targeting the management level staff moving to this area. Then verify traffic migration models also to tourism means traffic. A lazy underwriter ignores this. A top tier GP will show you how their specific assets, avoiding the primary bottlenecks in the Dallas Parkway, or how the egress pathway shield their traditional white collar actually tenants from the peak weekend resort flow. Those are the things you also want to look at. You want to look at the traffic consideration. Does it hinder or advance your deal prospect in terms of profitability? Operational aspect of things does matter when it comes to all this deal when you dissect them critically. Operational detail is what separates a stable asset from a frustrated tenant base. So you want to look at it holistically. Ask your GP question. I always say this. You cannot be docile as a passive investor. You have to ask questions. You have to ask your GP questions concerning your deals, concerning what it means. Don't be too timid not to ask questions. So let's just look at things in a summary aspect of them. The bigger picture for 2026. Let's bring it all home. The lesson of South Frisco is pretty much here in 2020 is that real estate value of flow major. It really boils down to major structural capital. When a global powers like NB Universal drops over $500 million into a localized market like the South Frisco axis, they've already run the 30-year data model. They don't just put money in an axis like that. And just giving you an insight on how to forecast, how to read the minds of some of these corporate giants. Sometimes you can pull up data that will tell you, but they've done the homework. They've done the 30-year forecast, and they've decided that it would be a smart thing to put something like that in South Frisco. They know the population is there. They know the infrastructure is built to scale, and they know the wealth is concentrated there. So as an apartment investor, your job is to draft behind that institutional capital. The universal effect is fundamentally changing Frisco, I can tell you that, from a high growth suburb into a premier self-contained entertainment and corporate metropolis. Now the baseline demand is locked in. The supply growth is tightening, and the grand opening is just about to happen, weeks away. The window is to buy at a reasonable base before the submarket completely reprices itself. That's all I can say. Strategically position yourself, invest in that axis, whatever you want to do in terms of partnering with other GPs, however you want to do your sponsoring. Make sure you take advantage of this. 2026 is a great year that you can deploy capital into that axis. Now, in closing, let's visualize exploring the progress, the scale, and specific geographical layouts of the upcoming entertainment resort. You can pull up online, you can watch Universal Kid Resort grand opening, preview the video, the fly-through provided the realistic visual context of the massive 32-acre project. That will give you some real adrenaline, or rather will give you some real excitement. So this is currently driving multifamily demands and reshaping the local South Frisco economy. So that's my take about it. We've been diving deep into how entertainment tourism is changing the real estate landscape in the North Texas. If you're an active investor interested in seeing the macro data model we're tracking here in the Collin County axis of Texas, which comprises of a lot of cities actually, the city of Frisco, the city of Plano, the city of McKinney, and also some other cities in that area. If you want to track that, just tune on our podcast. If you want to join the community of sophisticated operators who are looking for past surface headlines, you need to join the conversation with us, and let's be looking at this axis together. Head over to Commercial Property Club website. Check out our latest market briefing. Also, you want to connect with us, also to www.commercialpropertyclub.net. And also, you can email me, Ola ola.i@commercialpropertyclub.net. Don't forget to hit that subscriber button when you connect with us on YouTube. Drop us a 5-star rating, review, send the link to somebody that needs to understand where the smart money is moving this summer. I'm Ola Ibiwoye. This has been the Commercial Property Club podcast number 44. I will see you in another episode. Stay disciplined, underwrite the micro data, and keep adding value as you invest in multifamily. You can also find me on LinkedIn, Facebook, and Instagram. I'm Ola Ibiwoye. Thank you for tuning in for this week's episode. We'll see you some other time. All right, take care. Bye.